Have you ever stared at an auditor's report? Maybe tucked into an annual financial statement and just wondered what those dense paragraphs really mean, or why some specific issues get highlighted while others seem, buried. Today's deep dive is into that essential, but let's be honest, often misunderstood world of auditor reporting. We're focusing on the pretty significant changes that completely reshaped these reports about a decade back, turning them from maybe just regulatory checkboxes into something more powerful.
Yeah, and to tools for understanding a company's, true financial pulse. Our mission today really is to unpack key concepts like key audit matters, CAMs, and going concern. We want to help you understand why these seemingly technical bits are absolutely crucial for anyone who wants a thorough grasp of a company's financial health, its performance, and maybe most importantly, where management is making its biggest, possibly riskiest judgment calls.
Right. And we're looking at a detailed source that really outlines the history and the specifics of these reporting standards. Okay, so where do we start? Let's maybe start with the why. Our source points to this big shift in auditor reporting that sort of finalized around 2015, driven by the International Auditing and Assurance Standards Board, the IAASB. What really prompted that transformation?
That's a great question, and it raises the point of who was asking for this, and the source is really clear. It was the users of financial statements. People like you listening, investors, analysts, they were demanding a more informative, more relevant, just more transparent auditor's report. They wanted, frankly, more than just a pass-fail stamp.
Okay, so the goal was really to make these reports genuinely insightful, useful for you, the reader, moving beyond just, like you said, a thumbs up or thumbs down. It's about giving you a window into the auditor's most maybe challenging work.
Exactly. A window into their thinking process on the tough stuff.
Okay, so here's where it gets really interesting, I think. The introduction of key audit matters, CAMs. The IAASB issued ISA 701 specifically for this, right? Communicating key audit matters in January 2015. And it applies to audits of all listed entities. So what exactly is a key audit matter?
Well, the definition from ISA 701 itself is key here. It says CAMs are those matters that in the auditor's professional judgment or of most significance in the audit of the financial statements of the current period. And importantly, key audit matters are selected from matters communicated with those charged with governance.
Those charged with governance.
Also.
The board, the audit committee.
Precisely. The people overseeing the whole financial reporting process. So think of it as the auditor basically saying, look, out of everything we examined, these are the handful of things that really required the most intense scrutiny, things that kept us up at night, so to speak.
That definition seems clear, but most significant. That still sounds a bit subjective, doesn't it? How does an auditor actually determine that? Are there specific criteria they have to follow?
Yes, absolutely. The standard doesn't just leave it hanging. It outlines 3 key considerations, things auditors have to weigh up. First, areas that are seen as having higher risks of material misstatement, what auditors call significant risks under IS 315. That's the rule book for risk assessment.
Okay, high-risk areas. Makes sense.
Second, significant auditor judgments related to parts of the financial statements that involved significant management judgment. Think about complex accounting estimates, things where there's a lot of uncertainty in the numbers.
Right, like valuations of provisions.
Exactly. And third, the effect on the audit of any big significant events or transactions that happen during the year, a major acquisition, for example.
Got it. So once an auditor flags something as a CAMO, how does it actually appear in the report? Is it just listed?
Oh, no, it's much more than just a list. Each CAM has to be properly described. And that description needs to include why the auditor decided it was one of the most significant matters. And crucially, how they tackled it in the audit.
How they tackled it. So what does that cover?
It can cover, the auditor's general approach, maybe a brief overview of the specific steps they took, the procedures, and maybe the outcome of those procedures, any other key observations too. It's not just flagging an issue, it's showing the work.
So it adds a layer of transparency for the reader. You see the issue and how it was audited.
Immense value, yeah. It's like getting a peek behind the curtain at the audit process for those critical areas.
Okay, that clarifies CAMs really well. But let's shift gears slightly. What about the fundamental assumption of any business, its ability to just keep going concern? We kind of know what it means, but how did the revised standard, ISA 570, sharpen the auditor's focus here?
Right, ISA 570 Revised. Well, going concern, as you said, it's about the company's ability to operate for the foreseeable future, typically, the next 12 months or so. The revised standard really pushed for better guidance on disclosures, especially when there's what's called a material uncertainty about that ability to continue. Auditors have to be much more explicit now.
So what if the auditor finds there is a material uncertainty? Maybe the company's in financial difficulty, but, and this is key, the directors have actually disclosed this properly in the financial statement notes. What happens to the auditor's opinion then?
This is a really crucial point and a big change from the past, perhaps. If the going concern basis of accounting is still appropriate meaning, despite the uncertainty, the company can realistically continue for now, and management has put in adequate disclosures about that uncertainty. Then the auditor actually continues to issue an unmodified opinion.
Really? An unmodified opinion? But surely they need to flag the uncertainty somehow.
Oh, absolutely. It's unmodified, but it comes with a very prominent flag. The auditor must include a separate section in the report. It comes right after the basis for opinion paragraph, and importantly, before the CAM section. It's titled Material Uncertainty Related to Going Concern.
Okay, so it's got its own spotlight.
Exactly. And in that section, the auditor has to point you directly to the note in the financial statements where management discusses the issue. It will state clearly that these conditions indicate a material uncertainty, casting significant doubt. But, and this is the punchline, that the auditor's opinion is not modified because of this specific matter, assuming the disclosure is adequate.
And the source gives an example, you said.
Yes, a clear example of the wording, referencing things like a net loss or liabilities exceeding assets, and pointing to the relevant note. It's designed so you can't miss it.
Okay. But what if that uncertainty isn't disclosed properly by management?
Yeah, well, then the situation changes. If the disclosure isn't adequate, the auditor would modify their opinion according to ISA 705, because, the financial statements would be misleading without that information.
Makes sense. Now, given how important this is, does a going concern issue often end up being a key audit matter as well? Is there overlap?
Absolutely, yes. It's highly likely. By their very nature, issues around going concern involve significant judgment, significant risk, all the triggers for a CAM. In fact, even if the auditor concludes there's no material uncertainty requiring that separate section, maybe it was a close call that the company pulled through, that close call itself, the assessment process, the risks involved, could still be determined to be a CAM under ISA 701.
So even if there isn't that big red flag section, you might still see it discussed as a CAM.
Precisely. It gives you insight into perhaps underlying financial pressures, even if they don't cross the material uncertainty threshold. Our source mentions examples like big operating losses, relying heavily on available debt facilities, maybe issues with loan covenants. Those could all be CAMs related to going concern assessment.
Okay. Now, auditors don't always give that clean, unmodified opinion. Sometimes it's qualified or even adverse. What happens with CAMs then?
Right, that's covered by ISA 705, revised, which deals with modifications. When the auditor issues a qualified or an adverse opinion, they include a section explaining why the basis for qualified adverse opinion. But what's crucial is the requirement to communicate other key audit matters usually still applies.
So even if the financial statements are considered fundamentally flawed, like with an adverse opinion where problems are material and pervasive, you might still have comms.
Yes, potentially. Though with an adverse opinion, the issues are so significant and widespread that the auditor might decide that communicating other separate comms isn't really necessary or helpful. In that case, the comm section might just refer back to the basis for adverse opinion section.
So it depends on the circumstances.
It does. The source gives an example of a qualified opinion, a specific issue, like wrongly capitalizing research costs where other comms were still reported. The key thing, especially with an adverse opinion, is that describing any other comms shouldn't somehow imply the rest of the financial statements are more credible than they are, given the overall adverse finding.
Okay. And what about the ultimate negative outcome? A disclaimer of opinion.
The disclaimer. That's when the auditor just couldn't get enough evidence to form any opinion at all. Maybe records were destroyed or management blocked access. In that specific, pretty extreme case, the auditor's report should not include a CAM section. They simply couldn't do the work needed to identify them.
Right, that makes sense. You can't report on key audit issues if you couldn't really perform the audit. Now, it feels like there are a few ways auditors can highlight things. We have CAMs, we talked about the going concern section. How do CAMs differ from those other paragraphs, like emphasis of matter or other matter paragraphs? ISA 706, I think.
Yes, ISA 706, revised. And that's a really important distinction the standards clarified. Emphasis of matter, EOM, and other matter, OM paragraphs still exist. But the IAASB specifically stated that communicating something as a CAMOM under ISS 701 is generally the most useful way to highlight significant issues, especially if they relate to something already presented or disclosed in the financial statements.
So CAMs are kind of the primary tool now for those really significant audit focus areas.
You could say that CAMs are about what was most significant to the audit process itself. EOM paragraphs, on the other hand, are used to draw attention to a matter that's already appropriately presented or disclosed in the financials, but which the auditor thinks is fundamental to the user's understanding of those financials.
Okay, different focus. Is there a rule then about using both? Could you have an EOM paragraph and a CAM section discussing the same thing?
No, there's a very clear rule against that. The auditor is explicitly prohibited from using an EOM or OM paragraph if the matter has already been determined to be a CAM.
Okay.
The IASB was quite firm. An emphasis of matter paragraph is not a substitute for describing individual CAMs.
So if it meets the CAM criteria, it goes in the CAM section, full stop. Not dressed up as an EOM.
Exactly, that's the hierarchy. However, it's still possible, theoretically, for something not to be deemed a CAM. Maybe it wasn't one of the most significant audit matters, but the auditor still feels it's so fundamental to user understanding that it warrants an EOM paragraph. Professional judgment comes into play.
Okay, that clarifies the pecking order. To make this a bit more concrete, could you give us some typical real-world examples of things that often end up as key audit matters?
Sure. Our source actually has some really good illustrative examples. One common one is impairment testing on goodwill.
Yeah.
When one company buys another, the extra amount paid over the net assets is goodwill. Testing if that goodwill still holds its value.
That involves forecasting future performance, right?
Well,
very judgmental.
Highly judgmental, especially if the goodwill amount is large. So management's whole assessment process, the assumptions they use, that often becomes a CAM because the auditor needs to scrutinize it so carefully.
Okay, what else?
Another example is the effects of new accounting standards. Like, remember when IFRS 15 on revenue recognition came in?
Oh yeah, that was a big one.
Huge changes for many companies. So the implementation of a major new standard like that, if it materially changing how things are accounted for and impacts the financials significantly, the complexities and judgments involved in adopting it can definitely be a COM.
Right, the transition itself is a significant event.
Exactly. And a third common one is the valuation of financial instruments, especially complex ones, or other assets and liabilities measured at fair value. Particularly when there aren't readily available market prices, so the company has to build its own valuation models. Those models often involve significant uncertainty, subjectivity, prime territory for a COM.
It's interesting, isn't it? What really comes through is that COMs aren't necessarily about finding errors, although they could be, but they often seem to be about shining a light on those really complex, judgmental areas or things with a massive financial impact where the auditor had to do their deepest dive.
That's a great way to put it. It's about the areas requiring the most significant auditor attention and judgment during the audit itself.
So let's bring this all together. What does this actually mean for you listening? Maybe you're studying for an exam, maybe you're trying to really understand a company's health, or maybe you're just curious about how auditing works.
Well, stepping back a bit, if you understand these elements, CAMs, the going concern section, how opinions can be modified, you can read an auditor's report very differently. It stops being this dry, maybe impenetrable document and becomes more like a roadmap. A guide to the most significant, most judgmental areas in that company's financials for that year.
So it points you to where the big issues were from the auditor's perspective.
Exactly. You get insight into what the auditor focused on, why they focused on it, and crucially, how they addressed it. It shifts the report from just being about the numbers to being about the process and the judgments behind those numbers.
So it's about being able to identify the basics, sure, but also really getting when an opinion is modified, knowing that critical difference between a CAM and an EOM. That knowledge really empowers you, doesn't it?
Yeah.
To critically assess the financial information you see, to spot not just obvious problems maybe, but those areas of high judgment or risk.
Absolutely. Spotting where management is making its biggest calls and understanding how the auditors check those calls out.
Okay, we have covered a lot today on the Modern Auditor's Report, from those big changes back in 2015 through key audit matters, going concern.
Mm-hmm.
It really brings the auditor's role into sharper focus.
Yeah, and what's fascinating, I think, is remembering the why we discussed at the start. These standards were meticulously designed, really, to empower you, the user, to give you deeper insights by forcing more transparency around significant judgments, risks, and where the auditor spent their most effort.
So next time you pick up an annual report and flip to the auditor's section, you'll know it's much more than just a formality, more than a checklist. It's a carefully put together document shaped by user demand, aiming to give you a clearer, more contextual view of a company's financial world.
Which leads to maybe a final thought for you to ponder. How might understanding these specific disclosures, the CAMs, the going concern flags, how might knowing where the auditor focused their attention actually help you make more informed decisions, whether that's about investing or research or just satisfying your curiosity about how businesses really tick?
Something to think about until our next deep dive.